The broader market saw a choppy consolidation session today following Friday's steep inflation-driven sell-off. While things managed to settle down slightly by the closing bell, the tech sector continued to feel the squeeze. Here is a breakdown of how the SPY performed and the core themes driving the action on Wall Street. SPY market action. The SPDR S&P 500 ETF Trust (SPY) experienced an intraday tug-of-war, ultimately closing just a fraction below flat. After opening near the upper end of the daily range, the index saw consistent midday pressure before finding structure at its lower support levels. Close $738.65, down -0.07%. Intraday high $741.40. Intraday low $733.40. Volume approximately 36 M shares, tracking slightly below its recent 30-day average. The Nasdaq 100 QQQ was the relative laggard on the day, sliding -0.43% as high beta tech names continue to see profit-taking and technical distribution. Macro news and driving catalysts. 1. Rebounding yields and rate cut expectations. The dominant narrative overhanging the market right now is a sharp resurgence in inflation anxieties. Following a spike in bond yields late last week, investors spent the day adjusting to a shifting macro landscape. Notably, shifting sentiment in the options market and short-term interest rate futures temporarily pushed the perceived odds of an upcoming Fed rate cut down to 0%. Higher for longer yields continue to compress valuation multiples, particularly across mega-cap tech and semiconductor names. 2. Pre-earnings hesitation, the NVDA factor. Market breadth remained fragile today as Wall Street braces for high-stakes earnings reports coming later this week, most notably from Nvidia, NVDA, and Walmart, WMT. NVDA slipped -1.33% to close at $222.32 as traders lightened technical exposure ahead of the print. The broader consensus is that this week's semiconductor earnings will decide whether the massive AI momentum trade has the fundamental fuel to sustain its current legs, or if a deeper summer correction is on the horizon. 3. Geopolitical headlines. Volatility was also influenced by fast-moving headlines over the weekend. Early morning premium pricing adjusted rapidly following news that planned military escalations involving Iran and regional actors were called off by the Trump administration. This headline helped ease crude oil prices off their intraday highs, offering a brief reprieve to equity futures during the cash session. 4. Technical backdrop. From a structural standpoint, today's price action looked like a standard cooling-off period after SPY successfully defended its multi-week win streak despite Friday's heavy volume drop. The index is holding above major short-term moving averages, but the underlying tape displays visible caution, characterized by heightened implied volatility percentiles, IV rank hovering around 34%, and a prominent put/call volume ratio of 1.11, showing that institutional hedging is picking up. Looking forward to the rest of the week, the market is facing a highly anticipated high-stakes schedule. Traders are bracing for a mix of critical corporate earnings, key housing data, and macro headlines that could break the current tight consolidation range. Here is the roadmap of what is driving the tape for the remainder of the week. 1. The main event, corporate earnings. While Q1 earnings season is over 90% complete, the absolute heavyweight reports drop this week. They will either give this multi-week bull run fresh legs or trigger a deeper pullback. Nvidia, NVDA, minus Wednesday after the bell. This is the undisputed macro driver of the week. Implied volatility ranks are flashing high alert across the semiconductor sector. SMHIV rank is up over 92%. Options markets are pricing in a massive expected move. Wall Street is highly focused on whether NVDA's forward guidance can justify its valuation, or if a sell-the-news event will drag down the tech complex. Retail giants, Walmart, WMT, and Target, TGT, will provide the definitive health check on consumer spending. Traders want to see if resilient retail numbers are holding up against sticky fuel costs, or if margin compression is creeping in. Housing exposure. Major homebuilders like Lennar, LEN, report this week, which will give a real-time pulse on how the sector is handling the recent rebound in bond yields. 2. Economic data and macro catalysts. With major inflation metrics, CPI, PPI, now behind us, the focus shifts to economic growth and real estate stability. Housing starts and building permits. Tuesday, Thursday. Given the sticky nature of inflation, the street will watch these numbers closely to gauge whether high financing costs are triggering a structural slowdown in residential construction. Fed speaker backlog. Several Federal Reserve officials take the podium this week, after fixed income markets briefly priced the probability of a near-term rate cut down to 0%. The market will hang on every word regarding whether the higher for longer stance is turning into higher for much longer. 3. Geopolitical risk management. The intraday yo-yo price action in crude oil futures underscores that the tape remains highly sensitive to headline risk out of the Middle East. Now that the White House has paused the scheduled military maneuvers against Iran, institutional desks are closely watching the Strait of Hormuz and energy corridors. Any renewed spike in Brent crude above the triple-digit threshold will immediately pressure equity futures via higher input costs and a rising VIX. The technical setup to watch. Structurally, the SPY is hovering just under its recent all-time highs, $749.53, while the VIX has been subtly climbing alongside price over the last 2 weeks, an atypical divergence that often signals heavy institutional hedging. Keep an eye on the 733-734 zone, today's low. Defending this level keeps the intraday bulls in control ahead of Wednesday. A breakdown below it opens the door to a broader retest of the lower daily moving averages. While price action on the SPY showed a quiet, sideways consolidation today, the underlying fear and greed sentiment is telling a much more nuanced story. Currently, the aggregate institutional tone is experiencing a classic divergence. The macro headline index sits in mild greed, but the short-term internal indicators are rapidly pivoting toward caution. Here is a deep dive into the current sentiment profile across Wall Street. 1. The core benchmark, CNN Fear and Greed Index. The CNN Fear and Greed Index currently reads 62.9, keeping the market firmly within greed territory. However, looking at the trajectory, momentum is softening. The index rolled over from a reading of 65 late last week and is down from a more exuberant 70 just a few weeks ago. Interpretation. The multi-month structural bull market is keeping the long-term indicators, like distance above the 125-day moving average, buoyant, but the immediate short-term data is beginning to cool off. 2. Breaking down the sentiment drivers. To understand why the market is holding a greed rating while price action feels heavy and cautious, we have to look at the individual components driving the sentiment. The bearish/fear signals, the internal drag. Options market skew, put/call ratio. This is one of the clearest signs of defensive positioning. The put/call volume ratio has ticked up to 1.11. Institutional desks are aggressively buying downside protection, puts, to hedge their long equity exposure ahead of midweek catalysts. Market volatility, VIX. The VIX has been quietly grinding higher over the past 2 weeks alongside the market holding near its highs. This atypical positive correlation usually signals that big money is paying up for portfolio insurance, anticipating a spike in broad market variance. Safe haven demand. U.S. Treasury yields have surged, with the 10-year yield breaking back above 4.5% and the 30-year breaching 5%. Money flowing into high-yielding cash and debt instruments shows a growing appetite for fixed, risk-free returns over high-beta growth equities. The bullish/greed signals. The structural support. Market momentum. Despite Friday's sharp drop, the SPY and S&P 500 remain structurally healthy and well above their core long-term moving averages. The macro uptrend hasn't been broken, which keeps this metric heavily weighted toward the greed side. Junk bond demand. High-yield credit spreads remain tight. Institutional investors are still willing to accept lower yields for corporate debt, indicating that while they are worried about equity valuations and inflation, they are not currently pricing in systemic credit or default risk. 3. The smart money versus retail sentiment. Institutional commentary today took a visibly cautious turn. Prominent voices, including JP Morgan's Jamie Dimon, hit the wires warning of too much exuberance lingering in the broader AI and tech complex. Furthermore, options pricing reveals a massive sentiment bifurcation. Broad index tape, cautious, heavily hedged, and defensive. Semiconductor sector, SMH, implied volatility, IV ranks have surged past 92%. This shows a concentrated spike in speculative premium pricing. Traders are aggressively loading up on both OTM calls and puts, positioning for an explosive binary directional move when Nvidia reports on Wednesday. The bottom line: the sentiment profile is in a transition phase. The surface-level index says greed, but underneath, the mechanics reveal a market that is structurally bracing itself. The high put/call ratio, rising bond yields, and elevated IV ranks suggest that market participants are actively pulling back on risk exposure and paying a premium for protection, choosing to wait out the massive macro and corporate catalysts waiting later this week. Right now, the tape is heavily favoring the day trader, presenting an uphill battle for swing traders and requiring strict passivity or automated rebalancing from long-term investors. When you strip away the daily noise, the structural environment reveals exactly how each style needs to approach this tape. Day trading market, active and highly prime. This is an exceptional environment for short-term, intraday operators. The combination of high implied volatility and clear technical crosscurrents is yielding clean, mechanical range contraction and expansion. The catalyst: the semiconductor complex, SMH, and megacaps are experiencing massive options premium loading ahead of Wednesday. When IV ranks cross into the 90th percentile, it creates clean intraday mean reversion and reliable momentum bursts. Actionable mechanics: opening range breakouts, ORBs, and VWAP relative entries have structural edge right now. Because the market is processing binary headline risks, the Fed speakers and geopolitics, morning directional trends are tracking cleanly to key daily pivots before hitting a wall of institutional hedging. It's a take your points and go to the park kind of tape. Swing trading market, extreme caution, the danger zone. Swing trading is currently facing severe structural headwinds. Executing multi-day positions right now exposes you to a high probability of getting chopped up or caught on the wrong side of a binary gap. The trap: the index is putting in a tight daily consolidation right below multi-week structural highs, but the VIX has been subtly rising alongside price. This positive correlation means multi-day risk is exceptionally expensive. The setup: carrying positions overnight right into the NVDA earnings print on Wednesday, or a cluster of housing data, means you are taking on massive variance. Standard technical indicators like daily Bollinger Bands are pinching, signaling an explosive move is imminent, but the directional edge over a 3-5-day window is virtually non-existent until the structural catalyst drops. Investor market: hold and rebalance, macro waiting game. For long-term capital allocators, this is a time for patience rather than aggressive deployment. The reality: the broader macroeconomic trend is still structurally bullish. SPY remains comfortably above its core long-term moving averages, like the 100-day and 200-day. However, with the 10-year Treasury yield breaking back over 4.5%, the immediate equity risk premium is compressed. The move active accumulation here is inefficient because large-cap growth valuations are stretched thin. Smart money is holding core equity exposure but letting cash drag yield over 5% in risk-free instruments while waiting for a true high-volume macroeconomic pullback to scale into long-term equity tranches. The verdict: strategy, status, execution strategy. Day trading, prime. Trade the morning volatility. Lean on intraday volume-weighted support/resistance, flat by 4 p.m. Swing trading, high risk. Keep position sizes small. Cut losses quickly at structural pivots. Minimize overnight exposure ahead of Wednesday. Investing. Neutral. Hold core structural wins. Avoid chasing high beta growth at these levels. Collect fixed income yield on side cash.